Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about trade widths, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
All right, so the study, all the data, the study's up here. What I did was I took all the different widths and then measured at the center strike at half-hour intervals what the profit was. Now look at a 15 wide. Now a 15 wide, this is almost exactly what you have, right? Between 11:30 and you're somewhere around $50 to $75.
Yeah, that's weird. I don't think I've ever seen that.
It's not weird.
Well, no, it's not weird. I'm just like,
that's what you should expect. Now, if this was super low volatility, it would even be higher. But if this was even higher volatility, it would be lower.
Kind of a contradiction.
I know.
Which is why you'd want to be wider on the fly that you put on to begin with.
Now, if you had put on a wider fly, the amount in the middle would have been much bigger.
Yeah, I can see that. Yeah. Your cost goes up. Let me ask you this. The risk in looking at this risk strategy is to go smaller or less cost or narrower in this higher volatility. You're taking a chance that's even going to stay in the tent.
And plus, when you go narrower, you're creating greater gamma risk by creating a curve that's taller with respect to the size of the fly. And so your price is going to be jumping all over the place.
Okay, because it's squeezed into that.
Yeah. Plus, with the wider widths, you're getting a better deal overall, right? And this is one of the reasons why I like showing the poor man's straddle. I do the big ass fly in the morning. I remember when we were down in Zombie Land, I would regularly put that on and the debit would be like 30, 31, 32. Occasionally, it might go a little bit below 30. That means that that fly, if I were to execute it, would only have a certain amount of available profit for that day and a pretty high cost at 30, 31 with an available profit of, I don't know, $20 or so, a little under $20, but more like $15. But today, if you had put it on, that same thing would have cost you what? I put it in here and
13?
Yeah, 13. So let's go up to it. There it is right there. Yeah, 1350. So you have this much profit to go and with much less cost. It's actually an asymmetric trade in high volatility, right at the center strikes. In low volatility, that zero line is up here.
Right. I guess that's what's confusing me. We're in a higher volatility regime, which
and low volatility, that zero line's up here.
So
I am not used to this.
Can I toss out an idea that helped me put it into perspective? Because we talk about volatility. When you have a high VIX, and separate that from the concept of volatility for a second. When you have a higher VIX, your actual volatility in these trades tends to be lower. That's why you get.
I would say your risk is lower.
Your risk is lower. That's what you need to say.
Yeah.
So you can go wider on your fly.
That's the hard thing to come to grips with because most people equate volatility with risk. Yeah. High volatility, high risk. No, it's the other way around for us. High volatility, lower risk.
So when your VIX is low, the actual prices tend to bounce up and down and they are quite volatile. But
you're going to have less for less opportunity, more sensitivity to price when VIX is low. Therefore, the risk is higher. Low volatility, high risk. High volatility, low risk.
Thanks for watching guys, I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks guys.